So what are the ramifications of this problem?
Well, there's really multiple ramifications. Some of them are more narrow, some of them are systemic. So, I suppose on a more narrow basis, if I'm a bank that owns these securities or an insurance company that owns these securities, a lot of the regulation for those kind of entities are geared specifically about the ratings. And so if the rating goes below X, all of a sudden the security is considered no longer a good security for that institution. And what happens then by hard coding in the rating into the regulations, it creates this cliff effect so that the security is okay if it's rated above investment grade, but as soon as it's below investment grade, you take out 90% of the investor world and nobody can buy it, and so all of a sudden it goes from fine to extremely toxic, and you have this big cliff effect, which is why you see the price of these things go down so dramatically. So for a bank who may own a lot of these downgraded securities or insurance company, then the regulators might come in and say, wow, you got a lot of these downgraded securities, compared to the capital you have, there's a problem here. You got a big volume of these downgraded securities. And so then all of a sudden the regulators might say, okay, we've got to watch you more closely. You've got to start watching your capital because you've got all these problem securities. Well, the question is, what are the actual dollars at risk on these securities? It may be that I have a lot of downgrades, but if I have 10 securities, each are going to lose at 1 cent on the dollar, or $1 out of 100, then I might not have that many dollars at risk, but all of a sudden it feels like you've got a lot of problem assets. And so you get regulatory criticism, which might mean all of a sudden, oh, I'm a bank, I got to go in capital conservation mode. I got to start preserving capital, which means I can't maybe make as many loans. And then all of a sudden we're into systemic implications. Wow, if I got a lot of these entities that all of a sudden have to circle the wagons and conserve capital, then there could be a macroeconomic effect in terms of restriction of credit in the economy. So that would be a major implication. A second would be just general liquidity in the marketplace. So a lot of these kinds of institutions like to use this kind of security as a collateral when they borrow somewhere. So if it's a bank, it might be at the Federal Home Loan Bank or the Federal Reserve. Well, those organizations that lend to a community bank, for example, have rules that say, hey, you got to have an investment grade security. Well, all of a sudden this thing goes to non-investment grade, they won't take that as collateral. So instead of saying, well, we'll give you a 10% or 20% haircut, so we'll give you some credit for that. Basically, it's a zero, it's an all or nothing. No, you have no credit for that. So all of a sudden, I got a liquidity issue because of this cliff effect, even though the bond actually might be worth 98 cents on the dollar. And so that's a second, so we got restriction of credit, we've got liquidity, and then we've just got a problem in the mortgage-backed security market as a whole, because of all mortgage loans that are made, about 60% of them end up in a mortgage-backed security. And so, we've got the current administration trying to help unclog the plumbing problem that's in the economy, yet we've got this problem in the mortgage-backed security market, which is, again, 60% of all mortgages get securitized. So as they try to pull down interest rates to make mortgage rates go down and kind of help what's going on in the housing market, the market's resisting a rate fall because these loans that are going to get turned into mortgage-backed securities, there's this clogging in the back end of the market because of these artificial issues related to ratings. And so, until we fix kind of the wholesale markets and those kind of issues, the retail markets won't fully get fixed, and we won't get kind of liquidity and fluidity back into the financial markets.
What are the implications for the availability of credit if the ratings aren't addressed?
Well, we got two problems. One is the legacy assets. We've got trillions of dollars of legacy assets that are rated well below investment grade, considered toxic. And unfortunately, in a leveraged institution like a bank, like an insurance company, they don't get credit for those assets. Big capital charges for those assets, creating a lot of stress in the system. And when I have stress in the system, I'm not going to lend. But more importantly is going forward. If I know that I may face this music again on a multiple obligor asset, then I'm less likely to buy one in the future, which means the likelihood of a meaningful securitization market going forward is a lot less. And that's critical to the United States. We need a securitization market. Unless we don't care about auto loans, unless we don't care about home loans, unless we don't care about student loans, boat loans. All those loans are generally put into a security. We don't fix this rating mess, I think the securitization of those is very, very unlikely, or at least nowhere near the volume that we've seen in the past.